Everybody, today is Monday, August 2nd, 2010. Let's take a look at the S&P 500 here. We had a good day today. Yesterday the market was showing that a lot of stocks were set up bullishly, and today the market did gap higher, and we had some nice follow-through on that strength as well. In fact, let's take a look at the 1-minute chart. You can see, we'll just frame it here with the 2-minute chart. Here we can see the big gap higher right up to daily R2. We had a little bit of hesitation in there, and then it popped back above that daily volume weighted average price. And as I say, this is a very good pattern that occurs a lot of times. That is, it corrects a little bit below the VWAP, and then you get a rally. Now, not always such an explosive rally, but to be a buyer in this area with the stop just below here is a great way to day trade the S&P 500 after we get a gap higher. A lot of times people look for it to fade, but in fact it turns into a trend day, which is what we saw today. Now, we're headed, it looks like, for a test of the June highs at 113.20. That just seems inevitable here, and the reason that that level is so important is I think it's going to get a lot of attention because that is, just as a reminder, the basis of this pattern of lower highs and lower lows that we've seen on the weekly time frame. Now, getting up above it doesn't mean, okay, now all of a sudden the weekly time frame has turned higher, because sometimes we'll get some false movement in there. But it is very encouraging to say that at least the market at that point will have turned neutral on the weekly time frame rather than this lower highs and lower lows pattern. So, just like people were looking at this breakout as bullish, it was still below the 50-day moving average. But now, of course, we've broken this trend line a couple weeks ago. We have this pattern that's been emerging. Last week I wrote an article saying that this 105.80 area is going to be an important level for this trend. Well, now we look at this definition of trend and we say higher highs and higher lows. Well, now that we've moved higher and we have the higher high, here is our more important level. And that's also where you can see right now we have that blue 20-day and that green 50-day moving average. So this area in here right now, 108.70, really, that's the more important level. Even for a longer term investor, I think if you're long with a protection of your stop down here, you want to raise your stop up at this point. So we have this market showing us encouraging signs. We've also been monitoring this inverted head and shoulders pattern at the resistance level of 15 in the XLF, and that 15 level we can see obviously has been horizontal resistance, but it also takes on significance from another group of participants who've been just looking at the 200-day moving average, and they've been saying, hey, it's at that 200-day moving average and now we're back above it. So we have encouraging action from a leading market group, or a group that tends to lead the market. We have this bullish inverted head and shoulders pattern, which if you take a look at any technical analysis book, it will tell you the height of the pattern added to the breakout point is what your price objective becomes in the financials up near 16.5. I wouldn't suggest you buy it here and look for that. I mean, it could happen, but you want to manage risk on the shorter term time frames. And even on the daily time frame, if you were going to buy that, though, you could put your stop down just about that 14.50 level and still have a 1 to 3 risk reward ratio, meaning risking 50 cents for the opportunity to make $1.50. Of course, you'll want to raise that stop as the market rallies, if the market rallies and doesn't stop you out. But we do have a bullish look from the 10, 20, and 50-day moving average. We look at that 30-minute time frame. We see that this is that level that was kind of just recently making more of that cup and handle type look. Now tomorrow, if we were to break down below $15 a share, I think a lot of people would panic and say it was a false breakout, but I think you want to give it down to about $14.80 near that 5-day moving average, and just to give it a little bit of wiggle room near this larger level that a lot of people have been looking. So we're seeing a lot of encouraging signs. We had 2,600 advancing stocks today, 464 decliners, and for the SPY, it just seems inevitable that we're going to test that 113.20 level. And if we draw some Fibonacci on here, we can see that, of course, recently we found that that 50% retracement level, and above that is the 61.8% retracement up here at about 114. So as far as resistance levels go, 113.20 has the potential to be an area of resistance. Then that 114.18 area, and then you got to be looking back at the highs for the year, which are basically, back from January, that is, which was about that 115 level. So we have this pattern of higher highs and higher lows. We broke past the 111 today. We also broke past the 111.80. So what we want to do is we want to see that any pullbacks in here will hold 111.80 and then 111. If we start breaking some of those levels, then you have to become more defensive. But overall, this market has been showing this pattern of higher highs and higher lows, and when it gets back above those rising 5-day moving averages, that's the time to be involved with your stops on the long side.